Sikshayati, platform for eminent authors, engaging teachers, successful students. To know more, email. Valuation principles. There are several principles of valuation of assets and liabilities. Historical cost. Under this principle, assets are recorded at cash or cash equivalent paid or the fair value of other consideration given to acquire them at the time of their acquisition. Similarly, liabilities are recorded at the amount of cash received or expected to receive in near future. Example, an asset was purchased for rupees 19 lakh, so this is the historical cost of the asset. In case of tax payment, until the income is earned, tax payable amount cannot be determined. In such case, the tax liability is determined on the basis of historical cost, that is, estimated income amount will be historical cost. Current cost. Under this valuation principle, assets are carried at the amount of cash or cash equivalent which have to be paid now to acquire some same or equivalent asset was acquired currently. Liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligation currently. Example, a liability is due to a creditor for rupees 5,000. So 5,000 is historical cost. Now the creditor informs he will allow 6% discount on instant cash payment. Thus the current cost of the liability would be 5,000 minus 6% of 5,000, that is 5,000 minus 300 is equal to 4,700. Realizable value. Under this principle, assets are carried out at the amount of cash or cash equivalent that could currently be obtained by selling the assets. Similarly, liabilities are carried out at the present value of future net cash outflows that are expected to be required to settle the liabilities. Example, an asset was purchased for rupees 15 lakh 3 years ago. Now its written down value is 10 lakh. It can currently sell at rupees 13 lakh and selling expenses would be 2,000. Its realizable value is 13 lakh minus 2,000, that is 12 lakh 98,000. Present value. Under this principle, assets are valued at present value of future net cash flows generated by the assets. Similarly, liabilities are carried at present value or future net cash outflow to settle the liability. Assets are carried at present value of net cash flows generated by the concerned assets in the normal course of business. Liabilities are carried at present value of future net cash flows that are expected to be required to settle the liability in the normal course of business. Examples, at the discount rate of 10%, present value of rupees 1 after 1 year will be 1 by 1 plus 0.1, that is 0.909. After 2 years it will be 1 by 1 plus 0.1 square is equal to 0.826, so on. So liability of 10,000 is payable after 2 years. Its present value is rupees 10,000 into 0.26 is equal to 8,260. Thank you for watching the video. Kindly write your comments. Click on the red subscribe button at the bottom of the video to get more details and free ebook. Email us.